My name is Linda Hellström, and I'm the founder of GRC Watch. And today I'm going to host a webinar chat with Frank Schaffer from Luxembourg. And the topic for today is KYC on portfolio companies / assets, and also what we call Know Your Assets. And just to give a brief background, both me and Frank, we have been in the compliance space for many years. And Frank, we met a couple of years ago I think it was at some event in Luxembourg. And then we started talking about different types of compliance challenges, and we've stayed in touch. And we just thought that this topic could be of interest since not a lot of things have been written about this topic. We just thought that we could share some ideas about this. And since you are a true expert on this, just to give a really brief background about Frank, he's running a consultancy firm in Luxembourg. He's an AML expert, and he has previously worked at Schroders, Franklin Templeton, and many other companies. And what we say in this webinar, I just want to stress that please don't take it as legal advice. You would, of course, have to speak to Frank and tell him about your concrete case in order to get real legal advice. But we still hope that it will be of value for you. And the reason why I'm interested in this topic is because we have a lot of asset managers in the GRC Watch network, and they can perform KYC on portfolio companies and assets in the portfolios in our network. So we have a dual interest in this topic. But that's the introduction I was planning to have. Frank, do you want to say something, or should we just kick off with the list of questions that we prepared?
Maybe just to thank you for the introduction, Linda, and maybe just to clarify again, so we never give legal advice. We share here our views, our opinions. If I look at the list of the participants, I'm very impressed, and many people I know who are excellent people in AML as well. So I hope that you can also participate in today's discussion. Yes, let's start.
Yeah, fantastic. And it's not meant as we don't have like a 20 slide, and we're not going to go through a lot of rules and stuff. It's more going to be concrete questions related to this topic. So as Frank said, feel free to ask questions. But to kick off, we had a first question, which was KYC on portfolio companies / assets. And we also say know your assets. What's the legal basis for that, and what is the minimum that you should do? And does it matter if you what type of asset manager you are, if you compare, for instance, a UCITS manager with a private equity manager? A quite big question, but I'll throw it at you, Frank.
Okay, thank you for the big question. Yes, so the concept of KYA, as most of you know, came up around 2019 for the first time. There was initially a CSEF circular, which mentioned you should consider the risk of all new assets, also from an AML perspective. And then later on, we had in Luxembourg's revamp of our famous 1202 regulation, where again, there was a paragraph, it was Article 34.2, where they say you should consider the risks linked to your investments in your due diligence process. And then obviously CEF started to talk about it. At ALFI level, we tried to have a working group, and we had working groups actually with the aim to ultimately agree a position with the CSEF on the topic. But as of today, this did not happen. And so it was always a topic a bit of controversial and also not clear what should be done. Is there really any legal basis or not? So today we try to clarify a little bit what we can clarify. And so back to the question. So in the law, what we know is to perform or to prevent money laundering within business relationships. So as long as the fund has a business relationship with a broker, or for instance, with a private equity company into which he's investing, or with another investment fund, according to our Luxembourg definition of what is a business relationship, you are obliged to perform the traditional know your customer on your investment target. Again, maybe another fund, maybe a private company. And if you're in the world of loan funds, debt funds, and your fund makes available loans directly to borrowers, you have an obligation to also perform KYC on these borrowers. So it's actually, we're in the world of the traditional know your customer, because as a business relationship, we do the normal KYC rules. And then we added, obviously, with the obligation as well to screen for targeted persons under the EU and UN sanctions list. So broadly speaking, that's KYC. So we're still not still at KYA. So KYA then is the concept then was a bit enlarged. And everyone tried to work out, so what do we have to do? I need to risk rate my portfolio, on which basis? We could now go into different type of asset classes, but fundamentally it's this obligation in KYA started already with a simple obligation that you have to ensure that you're not investing into sanctioned securities. So the minimum control most people have put in place in the framework of KYA was to ensure that whatever they buy, they invest in, is not subject to sanction. Because this obligation is disconnected from your basic KYC obligation. It's a law of December 2020. And so it comes on top of the basic KYC obligation.
But that's a good introduction. And then you and me also spoke about, I mean, that's the Lux perspective. And if you look outside of Luxembourg, what can you say about the rules then and what you should do? And if you compare it with the Lux view?
It's an interesting question.
And hard to answer.
Yes. So in general, the concept of KYA is not very famous outside Luxembourg. Even the obligation to perform due diligence on the counterparts of transactions is a concept which in Luxembourg came up around 2017, where we sit together with C7 in the old days, and we tried to clarify who are the business relationship of investment funds. So I'm not aware of any other jurisdiction where you would have a similar interpretation of the law. But again, we have to be careful because I don't know everything. I don't want to say something which is wrong, but at least we can say that the pure concept of KYA, which is know your asset, at least from an AML perspective, does not exist elsewhere. Again, that's to the best of my knowledge.
Oh, okay. Yeah. I think that's the best answer we can give in this webinar. But you actually have a slide, and I don't know if I should bring it up, but where you listed a couple of questions that you could raise in order to, when you do the KYC, in order to show the reasons why you should do it. It's the triangle slide I'm talking about.
Yeah, with pleasure.
So maybe you can start talking about it, and then I will share my screen meanwhile.
Good. Yes, so initially when this whole topic came up, and many, I think, of you know me, and we talked maybe already about it, there was a real uncertainty of what should be done and why should it be done. And one uncertainty was linked, if you have, for instance, or I go even one step further, the reason why this whole topic came up was that some funds, especially in the private equity world, or the real estate world, but also in the infrastructure world, they made investments into assets which turned out to either even not exist or to not have the properties as foreseen. I can remember a case I had myself where we build a building in Italy, and when it was finished, it sank in the sand. Actually, the builder didn't follow the plans. He didn't build the building as to specifications, and we ended up losing a huge amount of money. But there are other cases where, for instance, asset manager bought a forest in the Amazonas, and then couldn't actually identify which piece of forest they bought. Or they bought, for instance, solar panel fields in Italy, And when they made the on-site due diligence visit, it turned out that there are not so many solar panels as they expected to be on the field. So, or another company, we had in Luxembourg, famous story as well, where an asset manager invested into a Luxembourgish company, which was supposed to have employees who was also selling, funny enough, again, solar panels to Africa. And it turned out the whole company was just a fake. All the numbers were make up, everything was false. So these are the risks when you do investments. And when we discussed this point one day with some experts, they told us, yes, but since fraud in Luxembourg is also a predicated offense, if you do AML, you have also to prevent fraud. And that's maybe what Linda wanted to mention earlier, what happens in other jurisdictions. Where then we said, if KYA is about fraud prevention, then Luxembourg is not alone. Then you have the UK and other jurisdictions, all taking measures to prevent fraud as a matter of fact. But fraud prevention as such is not really part of our AML obligations, because the AML obligations are really on knowing our customers and adjusting the KYC measures, considering actually how we trade an asset, where the asset is maybe based. But the focus remains on ensuring that we are not helping somebody to launder money in a transaction. While fraud prevention is a bit different, where you, as we write it here, for instance, try to ensure that if you buy a company from somebody else, also you have no direct obligation of KYC on the company, but on this counterpart from who you buy it, you still want to ensure that the company is real, that the building is real, or whatever asset you have purchased fits actually your expectations. So that is a little bit more operational risk management, similar to reputational risk management, credit risk management, etc. While our AML obligation is a bit more on the side of preventing money laundering and economic sanction.
Mm.
And maybe we can jump to the other slide, about the business risk assessment.
Okay, so
this one.
yeah,
The
good.
previous one, the other one with the
Oh,
money
you mean
flow.
this one?
Exactly, yeah.
Yeah, okay.
We tried here to summarize again our legal obligations in Luxembourg. And again, this is not legal advice, it's just us reading the law, the circular, the CSF regulation, trying to understand what's written inside. And we have this basic obligation to perform a business risk assessment, to then draw our AML policies in line with the risk identified and take the right due diligence measures. That is the basic. And then we have in the regulation 1202, this clarification, this kind of special article, which may be surprising to many, that in top of considering the risk linked to the customer, the country, the product, the services, you should also consider the risk linked by the investment and then adjust your due diligence measures accordingly. And the whole paragraph of this regulation actually says you should do this assessment on an annual basis. And you may notice that we are back to what we call our annual risk assessment. And so knowing the risks linked to your investments is actually part of your overall business risk assessment. And the same spirit was also in the CEF circular itself, where as well we could read in this point 354 that every IFM must implement actually processes to identify and assess the risks, including money laundering risks in relation to new type of assets. So again, here we speak more about a broad understanding of the risks and how you will handle them as opposed to an individual risk assessment. For sure, once you have designed your framework considering all these risks, when you apply it now in practice, you should actually have adopted risk mitigating measures to your investment. And maybe we can give here also some examples to demystify the whole topic.
Yeah, that's what my next question was.
Because it sounds a bit strange, maybe.
Yeah.
But maybe just some examples of again real cases where things didn't go as expected. So normally, for instance, and I refer here to one of the latest EU risk assessments published on real estate investments. When you buy normally your your properties, you have defined your investment policy, you have identified what kind of properties you want to buy. You also know more or less from what kind of counterparties you want to buy them, but you may end up in a situation where the seller is maybe a company where it's not very clear who has the ultimate control because it's owned itself by maybe a more complex structure above. And it's even maybe not so evident how they initially acquired the property. So all these risk factors, which are unusual compared to your normal counterparties, risks you should try to mitigate before you do the transaction. And the idea of the regulators was that obviously you do not discover these risks every day on the ground, which is reality, by the way, but you should actually have thought about them up front and accordingly designed your KYC framework that when they appear, you can identify them as being unusual, more risky, and accordingly take the right due diligence measures.
And may I just jump in there? I mean, it's one thing to do the initial KYC, but I mean, this will be a generalizing answer. But how good do you think that companies in general are at performing the regular KYC after the initial KYC?
That's a good question, actually. Maybe a little look into the reality to give a bit more flesh on the bones to this whole topic. So some people thought that KYA means you have to perform a full due diligence on all the companies in your funds portfolio. Let's exact about a UCITS fund. UCITS funds buys all the stocks of a famous index. The question is, do you have to perform now a KYC on every company? The answer is no. You have no business relationship with them, so you have no obligation. And then the CSEF recommends, asked, that obviously you still risk rate all the assets. And then you should maybe think about, okay, if the risk rating I give should simply be an indicator of money laundering, then you may want to consider, for instance, on which venue am I trading my stock? Do I trade it with a normal bank, normal broker, or is it a private transaction, which then would have higher risks? So if you want to risk rate, for instance, an equity portfolio in your UCITS fund, you may choose risk indicators which are meaningful for you, which would be totally different, obviously, in a real estate fund or on a debt fund. So for instance, on a private, again, make your own risk assessment first to work out where are the real risks you may see. But for instance, one question we had 2 years ago, and we asked the CSSF about it, and we got an answer which I did not fully agree with, but I can share it with you. We asked the CSSF actually, why should we perform a due diligence from an AML perspective on a company in a UCITS portfolio? And we got the response back, well, if a company you have invested in is doing money laundering, then the investment fund manager may also be responsible, let's call him even guilty, for money laundering. And we said, okay, so actually all the systemic banks, systematically they're exposed to money laundering issues. Does it mean that I can no longer buy shares of a bank? Because otherwise I would end up as a money launderer systematically. It shows a little bit the limit of this thought. Another example was Ericsson. Ericsson was caught in corruption. Does it mean now that the shareholder who invested into Ericsson becomes also now a criminal because they simply held the shares of Ericsson? And there are some cases where you may say yes. For instance, if you would have been yourself part of the management of Ericsson, if the fund's board manager would have a seat in the board of Ericsson, have been aware of it, he may be responsible for this corruption, but otherwise a normal investor would not be responsible. So there's a fine line actually between managing money laundering risks, which in the sense of preventing money laundering to take place, which is our obligations as obliged entities, and then managing operational risks, which is managing, you know, the risk of fraud, the risk of reputation, etc. So maybe I have a reputation risk if I was a shareholder of Wirecard, but I'm certain a money launderer because I invested into Wirecard, as an example.
Mm.
And then we go down the route maybe of some private equity funds where you are, if you have a business relationship with that company in which you have invested, there you do your due diligence. If you have no seat on the board, fantastic. If you are on the board, then you may be part of the company or the operation. So if the company would commit a crime, you would have a problem as a board member for sure. So there you have to adapt your risk measures. On the real estate side, again, if you buy buildings, you on one side perform your traditional KYC checks on from who you buy the building. But again, if within the building later on there are illegal activities, then you need to work out, is it reputational risk or is it maybe something you're responsible for? I will not answer this question right now.
Mm. Well, but that's interesting. And I mean, we've discussed this before the webinar as well. I asked you which type of asset manager do you think should improve? And of course, we are generalizing. There are fantastic cases out there of managers doing this in a perfect way. But you mentioned that you thought that private equity fund managers probably need to do a bit more. But have you seen any area in which, or any specific type of private equity fund where you think that they should improve their process for KYC on the investments? You have mentioned several concrete cases already, but just if you could give one more example of that.
I would say that when we started to introduce this new concept that you have an AML obligation on your counterparty, on your transaction counterparty, there are still, we note from practice, many companies who are in the process of implementing AML frameworks on the assets they invest in. What we simply see very often is that the compliance officer is left alone in a corner. He says it has to be done. And the asset management part, who sometimes in other jurisdictions in Europe, other countries in Europe, or even outside Europe, they have difficulties to understand actually what's really required. And so there's then a back and forth on how far to go, what should really be done, how should it be documented. So I would say this is kind of more practical side of the implementation. What should we really do, which is challenging, again, depending on where the estimates are coming from, what the culture is, what their way to invest is. And then there's a traditional problem of timing, because very often deals are done at a stage where the compliance officer may not be fully aware of it. And then he may get a new investment for review in the last minute, in the last 24 hours before it's really done. So these are more the practical issues we are facing every day. And we have seen that in some houses with some asset managers who are, I would say, a bit better educated by their RCs or by the environment, by the governance processes. They have tried to really include KYC into their processes. It's part of the same due diligence as they do for legal risk, reputational risk, etc. And we know that there are other asset managers who are just discovering the topic, who have already maybe decided to take an action, but it takes time to implement the right framework. It takes time to work out how the company wants to risk assess all these deals. It takes time to agree on the due diligence processes with the asset manager, or maybe a third party who doesn't perhaps the asset manager. So these things take time. So it's a process where the industry becomes better in.
Yeah, and I think when I've been working with a lot with different types of due diligence, I think it's the same in other types of due diligence, that you need to start with looking at what type of risks are there, why should we do this, and then decide who should be involved. Because I can completely understand that compliance people may end up coming in too late in this process. But what else did we talk about? I'm just going to look at my notes. We have been focusing a lot on the AML rules. We have talked about prevention of fraud. But of course, we also have other types of regulations which require that you are checking your investments. And before the webinar, we spoke about ESG requirements, for instance. We will not dig into that topic in this webinar, but do you want to make a comment about that? I mean, other reasons for doing this check on your investments, but based on other types of regulations?
Yeah, actually, we discussed yesterday a bit of ESG, where as well, in order to, for the Article 8 and 9 funds, you have, for instance, to prepare your PAIs, positive adverse impacts. And in this context as well, you look actually at different types of risks, which also fall under the money laundering law. Like you look at environmental risks. If you commit environmental crimes, also now predicate offense money laundering. You look at bribery and corruption as part of the governance. You look at labor law, social law. And currently in Luxembourg and also in the future in Europe, all these, if you commit a crime in these areas, it's all predicated offenses to money laundering. But again, even on the PAIs, you need to report on them. But there's no straight link that if you identify, obviously, a company which may commit environmental crimes, that you as an asset manager would become yourself a money launderer because you invested into the company. That link doesn't exist. And again, we are back here to operational risk management. The idea is simply that be aware of what is happening in your portfolio, be aware of any kind of adverse information you hear about it, and then manage these risks amongst your traditional operational risk. AML, i.e. KYC, is required where you have a straight business relationship with the investee, be it an investment fund, be it a broker, be it another bank, be it a private equity company, be it a borrower. There you are in the world of KYC again.
Yeah, but I think you wrapped it up there in a fantastic way. I mean, have I missed anything? I'll see if we have any questions in the... We don't have any questions as far as I can see, but is there anything else you would like to add? I mean, it's obvious that Frank is a true expert on this matter, and if you are an asset manager and you need to create this kind of process for a new fund, or if you need to sharpen up the process that you already have, you should definitely get in touch with Frank. And if you are interested in performing KYC on portfolio companies and need a tool for that in order to get the information you need, you can speak to me and I will tell you more about GRC Watch. And Frank, we can share some of the slides after, right? Where
With
you
pleasure.
summarize this. Yeah, absolutely. So to all of you who participated, we will share the slides, and we will also share the recording and contact details to you, Frank, so that they can get in touch with you, and also contact details to me. But then I'll thank you, Frank, and thank everybody for joining this webinar chat, and I wish you all a real good summer.
Thank you very much, Linda. Thank you all for attending. Thank you very much.